Okay. Good afternoon, everyone. Welcome to this special policy session titled Challenges for Monetary Policy, Views from the Trenches. My name is Jordi Galí, and I will be chairing this session. Let me thank, before we start, first of all, the EEA, and in particular the program chair, Maristella Botticini, for giving us a chance to put together this policy session, and also, very emphatically, the European Central Bank for sponsoring this session as an institutional member of the EEA. So, as we all know, one of the distinctive features of the times that we live in is the central role that monetary policy plays in influencing the performance of the economy and of financial markets, both nationally and globally. And this role and the influence of monetary policy seems to only have grown over time, and more markedly so since the recent financial crisis, in line with the rise in the importance of the challenges that central banks have faced. Now, to discuss some of these challenges, past, present, and future, we have with us three distinguished panelists. They share two characteristics. First, they are playing or have recently played an important role in monetary policy making. And secondly, they have close links to the world of academia and economic research that this gathering represents. So let me introduce them briefly. So to my right is Benoît Cœuré, who's a member of the Executive Committee of the European Central Bank since January 2012. And right immediately to my left is Lars Svensson, currently an affiliated professor of the Institute of International Economic Studies in Stockholm, but deputy governor of the Riksbank, the Swedish central bank, until May of this year, and since May 2007. And to my extreme left, John Williams, who is the president of the Federal Reserve of the Federal Reserve Bank of San Francisco, and as such also a member of the Federal Open Market Committee of the Federal Reserve. Okay, so since we don't have much time, and really we want to cover a number of topics which we hope will be of your interest, and also leave some time for some questions for the audience, let's get started. So let's start looking back at recent years, and let's think about some of the decisions that central banks have taken during the financial crisis and in the aftermath of the financial crisis. And let me ask our panelists first to give us a very brief, synthetic overview of the main decisions that their institutions have taken during the crisis, and also to give us their assessment as to the effectiveness of those decisions, and if, with the benefit of hindsight, some things maybe should have been differently, or the timing should have been different, and so on. Okay, so let me start with Benoît Cœuré.
Thank you, Jordi, and thanks to you, and also to the EEA for the invitation in this lovely city. What can we say on the response to the crisis, and obviously from an ECB standpoint, with an ECB angle? What I would first like to say is that when you react to a crisis, when you manage a crisis, it's not like optimizing a given model. What's happening is that the economy itself changes because it's impaired by the crisis, it's affected by the crisis. So crisis management is not that much about optimization, it's a lot about plumbing, actually, because you have to repair many aspects, in particular, many transmission channels of monetary policies that have been impaired by the crisis. And when you think of the European crisis, Euro area crisis, we've seen this twin interlinked crisis, the sovereign debt crisis, and also some elements of a banking crisis, I have to say, interacting with each other, with the result that many transmission channels of monetary policy were impaired, and along several dimensions. Transmission was impaired along the term dimension, so the yield curve was not properly behaved because of illiquid markets, because of sovereign risk, because of banking risk. So all the term structures, the term premia were made fuzzy, were blurred by the crisis. And also monetary policy transmission was impaired across the horizontal dimension across countries. And so we've seen fragmentation of European financial markets. And that's very specific to the euro area, obviously. So what we've done to try to address these impairments is to provide liquidity. We've provided liquidity in a limited manner with the fixed rate full allotment operations. We've provided liquidity along longer horizons with the LTRO, the long-term refinancing operations. We've provided liquidity more evenly across institutions and across countries by extending our collateral framework, which was an important part of crisis management. And also we've tried to address a particular kind of impairment, which was the risk of euro breakup. So a particular kind of risk premia arising from the risk of a euro breakup, and that was the outright monetary transactions, the OMTs. And this has worked to some extent. Well, certainly not enough, but we've seen signs of financial markets healing in the euro area since last year, in particular since the OMT announcement. We've seen fragmentation receding. We've seen financial markets coming back together to some extent. So if you look at the target 2 balances, for instance, so which are a measure of intra-euro area claims by national central banks against each other, at the top of the crisis in July 12, the total claim of, say, Northern Europe, Northern euro area, to make it simple, over Southern euro area, was around 1,100 billion euros, and it's now around 800 billion euros. So this has receded by 1/3. So these particular statistics, this particular measure of financial fragmentation has receded by 1/3 over the last year. So this has succeeded, but it's still an ongoing process. So what are the lessons? To wrap it up, I would see 2 lessons. The first lesson is that, but we may come back to it later in the discussion, so I'm not going to expand, is that anything that the central bank does very much depends on the overall environment. Because we're talking of a banking crisis, we're talking of a sovereign crisis. There's nothing much that the central bank can do about it. So the success of monetary policy fundamentally depends on the efforts being done to improve the institutional framework and the efforts being done by other institutions to improve the system, to repair the system, to mend the system. That's the first lesson. The second lesson, in my view, is that it's a lot about providing insurance to financial market participants. Say the LTRO, it's about providing liquidity insurance to banks to make sure that they could refinance, that they could roll over their liabilities. And when you provide insurance, you have to provide it with a cost. You have to provide partial insurance. So there has to be a cost to the insurance that is being provided by the central bank. Or to put it in more academic terms, you have to find the right way to balance ex post efficiency and ex ante efficiency. Central bank intervention is about providing ensuring ex post efficiency. But if you want ex ante efficiency, you have to provide incentives. So you have to design incentive compatible contracts. And that may seem very abstract, but if you look at the OMTs, for instance, OMTs are conditional on a country subscribing to a European Stability Mechanism program with conditionality. So there is a cost to it. So to simplify a lot, the political stigma of a country asking for an ESM program is like a co-payment, it's like an insurance premium that the country has to pay to benefit from the insurance provided by the ECB. And it is very, very important that we have this kind of incentive-compatible framework when we act in a crisis. So that will be my second lesson. So did we do anything wrong? Because you asked a question. Is there anything that we should have done earlier or better? I would say that collectively we've underestimated the extent to which this crisis was a banking crisis. It was primarily seen as a sovereign debt crisis. It is a sovereign debt crisis, undoubtedly. It's also a banking crisis. It was also a banking crisis. And if something had to be done better, could have been done better, this would have been just to follow what the US have done and to identify at an earlier stage weaknesses in bank balance sheets, to make them public, to recreate a market for bank assets, and then to move on. And then we wouldn't face the same kind of tightness in credit standards that we face today in the euro area, and that is a real impediment to recovery.
Thank you. Lars, your turn.
Okay, let me talk about Sweden, which I think is a little special. Before the crisis, Sweden had basically a sound financial system, and it had sound monetary policy and very sound fiscal policy. So the shocks that hit Sweden, they came from abroad. Export collapsed, and the foreign financing of Swedish banks dried up. So those were basically the two shocks that hit the Swedish economy. The Riksbank responded by a very expansionary policy. The policy rate was dropped to 25 basis points, and there was generous liquidity support in kronor and in foreign currency, emergency lending by the Riksbank, also by the National Debt Office. There were no asset purchases, in contrast to the case in the UK or the US. Eventually, when the situation improved, the demand for emergency lending from the Riksbank ceased because it was lent at a higher rate. So the balance sheet had grown quite a bit of the Riksbank, but then it just shrank naturally when demand for emergency lending dried up. So then, I mean, things looked quite good, but then actually there developed a deep division in the executive board, because the majority in the summer of 2010 started a period of tightening monetary policy, even though inflation was on the low side and unemployment on the high side. And this was actually a very systematic and pretty strong leaning against the wind. And the idea was to prevent the growth of household debt. So it was more about household debt, which was a reason for this leaning against the wind. And the question is, was this premature tightening or not? Today I've actually published a post on a blog, Economistas, and also a research paper on my website arguing that leaning against the wind has actually some surprising consequences. It actually increases household indebtedness rather than reduces it. Let me quickly use a minute and see if I can show on a graph here what is happening. Let me see here. So here, suppose this is years. We start at year 0. Suppose we raise the policy rate 1 percentage point for 1 year. What happens? Well, inflation, the red curve, drops for a couple of years. The blue curve, GDP, drops for a few years relative to baseline. And real housing prices drop and then come back to the baseline. So that is what tight monetary policy does. Okay, this means that the nominal price level will actually fall permanently. You accumulate this lower inflation, the price level falls, and nominal GDP will fall permanently to a new permanently lower level relative to baseline. And of course, nominal housing prices will also fall down to a new lower permanent level. Okay, lower nominal housing prices means that new mortgages will be a little smaller because people need to borrow less when they buy houses. But new mortgages are a small part of the total nominal debt. So that means that the total nominal debt starts to shrink relative to baseline, but very slowly. So nominal debt just drops very slowly down to a new lower permanent level. But you see the price level drops quickly and nominal GDP drops quickly. So that means that real debt, the red curve, and debt to GDP, the blue curve, they rise. The dynamics is dominated by what's happening in the denominator, not in the numerator. So actually, real debt and debt to GDP and also debt to disposable income goes up and then slowly comes down. So actually, leaning against the wind, if the purpose is to reduce household debt, is actually counterproductive. Let me use up one of my future minutes and just show what this has meant for Sweden. Here you see that the policy rate, the dramatic tightening in the summer of 2010. Here you see what happened to inflation. It dropped down below the 2% target and is now even lower. Unemployment came down but went up and is above 8. Suppose we had kept the policy rate at 25 basis points throughout. Inflation would have been very close to target. Unemployment would have been much lower, maybe 1.2 percentage point lower. And debt would actually be a little lower. Debt to disposable income of households would be a little lower. So I think this has been a pretty counterproductive policy. And I'll get back to what conclusions one can draw for the future of this experience.
Okay, thanks, Lars. Let's move on to John.
Great. When Jordi asked me to describe what the Fed has done over the last 6 years in 5 minutes, I decided I'd either have to talk incredibly fast or just hit the very key high points in terms of all the activities we've done. I break it into 3 groups. The first is providing, as Lars talked about in the Swedish context, is providing liquidity and emergency lending during the very stressed time, especially early in the crisis. The second has been our involvement in bank supervision and trying to rebuild confidence in our financial system. And third, obviously, is monetary policy and unconventional monetary policy. In terms of the lender of last resort role, which of course central banks have always had, and going back to Walter Bagehot's principles of the late 19th century, the Federal Reserve was very active and very quick in expanding lender of last resort to depository institutions, term lending, and to other financial institutions back in 2007. In addition, we provided sizable swap lines with other central banks to make sure to provide dollar funding around the world in the very stressed environment that we were experiencing back then. So from a central banking point of view and lender of last resort, I think those policies were very, very successful. We acted quickly and in the right way. The problem for the U.S. economy, though, is that a significant portion of our financing actually comes through capital markets and not through banks. And this is a difference between the U.S. and a lot of European economies. So one of the challenges for the U.S. in terms of providing lender of last resort is, especially after Lehman's collapse, we saw a lack of liquidity and freezing up in markets, in the capital markets, in commercial paper, money market, and asset-backed securities markets. So the Federal Reserve had to quickly, on the fly, if you will, make policies to provide liquidity to those markets. And we were able to do so, but I'll talk about maybe later in our session, that there are a lot of limitations in what the Federal Reserve is allowed to do. We're not allowed to take credit risk, for example. And so creating lender of last resort programs for non-depository institutions, for capital markets, ended up being very difficult. I think we made, again, the programs we did provide liquidity, get commercial paper markets working again, but that didn't solve all the problems, and we did have liquidity problems for some time. In terms of supervisory activities in the banking sector, I think the Federal Reserve did play an important role there, especially in the stress tests, which occurred actually quite early in the crisis. The stress tests were reported in April of 2009. What they did in conjunction with the recapitalization of our major banks from the U.S. Treasury was, I think, quickly rebuilt confidence in our banking system, made sure that our major, largest banks were appropriately capitalized and on a path of rebuilding strength and providing credit to the economy. Of course, the most current issue that's still going on is the monetary policy. In terms of monetary policy, we cut the Fed funds rate down to 0 by December of 2008. So the Fed on monetary policy, given the weakness of the economy, given the low rate of inflation we were experiencing, acted aggressively to add monetary stimulus. But once by December 2008, we'd cut the funds rate to 0. The economy was still contracting severely. Inflation was running well below our 2% longer run goal. We obviously needed to find other ways to stimulate the economy, first through quantitative easing, through what's now ended up being trillions of dollars of purchases of U.S. Treasuries and mortgage-backed securities, with the goal of, even though we've got the short-term interest rates at 0, the goal of the quantitative easing programs or the asset purchase programs is to push longer-term interest rates, such as mortgage rates, auto loan rates, and other private rates down. In addition, we instituted forward guidance policies that were designed to basically manage expectations, help the public, and help the public understand what our monetary policy plans were over the future, and to basically try to push down longer-term interest rates through communicating lower interest rates for a long time. I think there's been a huge amount of research done on the Fed's unconventional policies, both in terms of quantitative easing and in terms of forward guidance. I think the research is pretty convincing that this has been very effective at lowering long-term rates, lowering mortgage rates, and these policies have worked. I will say that they don't solve all the problems. Because we've had a banking crisis, one of the challenges is that if you have good credit, if you are a corporation, lending and borrowing rates are incredibly low. If you have good credit, you can buy a house for an incredibly low interest rate. But the banking sector still is recovering slowly, healing slowly. So there are certain parts of our lending or credit allocation in our economy that are struggling to come back. That said, I would say these programs have been very effective, lowering interest rates. We're seeing the interest-sensitive sectors of the U.S. economy recover, housing markets coming back. Auto sales are now at basically normal levels already, and have rebounded a lot. So I think in general, the assessment is we acted aggressively, we acted with a lot of creativity, and I think these policies were really, all three of them combined, were essential to help the U.S. economy get back on track and keep inflation from falling too far below our longer run goal.
Thank you very much. So let's move on and let's look ahead. We just looked at the past. Let's look ahead. And clearly, I mean, interest rates are unusually, and I guess one should say unsustainably low these days. Sooner or later, they will have to return to what we could call normal or more normal levels. So how do you view the challenges that central banks may face during this normalization of interest rates? And in particular, you think what are the possible difficulties that you may face in terms of spillovers vis-a-vis emerging markets, and perhaps the need for some coordination among central banks, whether central banks of industrialized economies or also emerging market central banks. So why don't you share your views with us on this? Let me start with Lars now.
Okay. I mean, my general view is that central banks should focus on their domestic issues and stabilize inflation and unemployment in their own country, and not really be so concerned about what effects their policies have on other countries. Each country is responsible to handling its policy and its external disturbances. Of course, there are problems. There could be some problems for central banks who have big balance sheets when when interest rates eventually start rising. But let me not get into that, because there are people here who know that issue better. And I also think those problems are not so serious when you look at them. But in Sweden, this would not be a problem for the Riksbank, because the balance sheet is now back to normal, and we never bought any assets. But there is one issue that has been debated, whether perhaps housing prices and household interest rate costs, mortgage cost would rise if interest rates went back to normal. Fortunately, Finansinspektionen, the Swedish FSA, they have an excellent mortgage market report, and they actually have individual data on mortgages, new mortgages, and they can actually look at those and do stress tests and assess the repayment capacity of the individual mortgage takers. And this mortgage market report, I think, is a model for the rest of the world. It contains detailed stress tests, and what it shows is that the Swedish households with new mortgages, they have actually quite good repayment capacity, also with higher interest rates. And they pass stress tests actually quite well. They can manage higher interest rates, they can manage the losses to disposable income, and they can also manage falls, any housing price falls that could happen quite well. So I think it's quite important, to have this very detailed mortgage market report and watch out for the resilience of the household sector, and it seems to be quite good. And of course, banks are much better capitalized now, and overall, I think things look quite good from this point of view, and I see no reason to be worried in Sweden about higher interest rate. By the way, I think they will come very slowly, because I think the rest of the world will have low interest rates for quite a while. And if policy is good in Sweden, you cannot deviate too much from world interest rate, because otherwise the krona becomes too strong and export suffers and unemployment rises.
Okay, well, thank you. John?
Sure. I mean, obviously this issue of normalization or the eventual normalization of policy gets a lot of attention in the US and more attention today around the world. So adjusting monetary policy back to normal after any easing cycle is difficult. This time it's going to be particularly challenging for us, because obviously we have a number of moving parts in our policy, with the funds rate, the forward guidance, and the asset purchase programs. And of course we've added an enormous amount of monetary stimulus that we'll have to withdraw gradually over time. So there's no question that there's a lot of challenges ahead in executing the normalization. And the experience of the last few months with the bumpy path of more interest rates and flows across the globe can show that this may not always be an easy process. I think I'd like to make two important points from the Federal Reserve point of view. The first is that any normalization of policies is going to be based on the economic outlook and based on how we're achieving our goals. And I think we just have to keep our focus that any normalization of monetary policy is not set according to some calendar plans, but in fact is completely data contingent and forecast contingent. I also think what's very important for us, for all the reasons I'll talk about, is to continue to try our best to communicate our policy framework, to explain to the public, the global markets, what is our thinking about our future policy, what are our plans in terms of normalization of policy. Now, this isn't always easy. We have a state contingent policy where what we do in the future depends on what happens, and there's a lot of uncertainty about the future of the economy. And so we're trying to explain something that can be very complex. And obviously, recently we've seen some of those challenges get in the news, where people are saying it's hard to understand what the Fed is saying, given that we won't be we won't give such explicit, say, deadlines or something for decisions. But nevertheless, I'm very confident that we can continue to try to explain our policy framework, explain our thinking about the future. In terms of normalization, we at the FOMC have talked about this for the last few years. We have very definite plans, which we have made public. The first step will be obviously to end the current purchase program and stop adding to our balance sheet. Now, it's important to remember that even after we stop buying securities, we still have a very stimulative monetary stance with very low interest rates and a large balance sheet. Of course, eventually the economy will have improved to the point where we want to remove accommodation, and we'll do that both through gradually over time bringing our balance sheet back to more normal levels and, of course, raising the Fed funds rate. And in terms of that process, we can raise, one question I always get asked is how do you raise the Fed funds rate if you have a $3.5 trillion balance sheet? And we've spent the last few years developing the tools through interest on reserves and other reserve draining tools to basically, even with a large balance sheet, move up short-term interest rates by paying banks more to hold reserves at the Fed. So I'm very confident that we have the tools to adjust, tighten monetary policy, eventually normalize monetary policy. We have the plan in place, and we try to communicate that very effectively. And in terms of this question about international coordination, I think I agree with Lars. I think the key thing is we need to focus again on our goals of getting the economy back to maximum employment, keeping inflation near 2%. We also need to communicate very effectively with other central banks around the world what our plans are so that there's a good understanding of how policy in the U.S. is likely to proceed. I think that will help avoid at least somewhat the risks of a big market turmoil around this process.
Thank you. Benoît?
Well, first, let me make it very clear that the timeline of policy rate normalization is not the same in the US and in the euro area. I mean, activity has stabilized at low levels. Credit conditions remain very tight. And credit growth remains subdued. And the Governing Council of the ECB has been very clear in saying that policy rates will remain at the current level or lower for an extended period of time. Does it imply that we'll never raise rates? Of course not. We haven't changed our framework. So another way to put it is to say that the ECB will raise rates when risks to medium-term price stability will materialize. But, and it's an important but, that the Governing Council doesn't expect that to happen over an extended period of time. So that's exactly the same. So depending on your mood, you can use one version or the other, but it's the same at the end. So it's not a short-term consideration. Now, I see a general issue which applies to all regions, which has to do with the functioning of financial markets. That we have to, financial market participants have to be able to price risk. And under very accommodative monetary policies, under very generous liquidity provision policies, risk perception and pricing mechanisms have been to some extent sterilized or neutered by accommodative monetary policies. So one challenge over the next month and years will be for financial markets to recreate proper pricing mechanisms, to recreate two-way markets in all market segments, and to recreate a capacity to price risk. And that's not such an easy exercise, in particular in a changing regulatory environment and in a changing, with a changing structure of the financial industry. If you take the example of government bond markets, the capacity of banks to hold inventories of government bonds has been changed by the new financial regulations. So it's not clear at all to which extent the market making, primary dealership, distribution of bonds will be the same now or after the crisis and before the crisis. So these are structural issues. When it comes to the ECB, two remarks. First, all our non-standard measures have built-in exit mechanisms. They are all temporary. So liquidity provision was 3 years. I mean, now it's only 1.5 years, by the way. Some of the collateral measures that we've taken are temporary also. So the exit is built in our non-standard policies. So I don't see any particular difficulty in exiting from that standpoint. Where I see a challenge or a matter for concern is not at ECB level, but it's the ability of the financial system in the euro area to withstand higher interest rates. We have to make absolutely sure that European banks are able to withstand a different constellation of rates, and in particular, a different term structure for their funding rates. And this is why the asset quality review and the stress test that will be undertaken next year, in the first half of next year, by the ECB for the asset quality review and balance sheet assessment, and for the European Banking Agency Authority for the stress test are so important. And in a sense, it's more about the stress test than about the asset quality review, because it's about the funding models of banks. We have to be absolutely sure that the funding model of European banks is resilient, is robust, and that they can withstand a higher level of interest rates. So that would be my most immediate concern.
Thank you.
Do you mind if I add?
Please.
Sure. I think that point about the stress test and the resilience of the banking system is really important. It's one of the things the Fed's most recent stress test in our largest banks had analysis of a much higher rate environment. So this is also another point I just amplify, that the forward-looking nature of stress tests really allows you to weigh and carefully analyze some of the biggest macro risks or biggest financial risks, and I think it's a huge improvement relative to the old system.
Just one word on coordination, because I didn't answer your question on coordination, but my answer is very much similar to what the previous speakers have said. When you have a floating exchange rate, your monetary policy is autonomous, so you should use your monetary policy and your national policies to withstand any kind of external shock. I mean, that's the rule of the game. Well, it's very different when your exchange rate is pegged, but here we all live in regions with floating exchange rates. So it's about the autonomy of monetary policy, and that's, to be frank, one of the reasons why the ECB in July has decided on its version of the forward guidance, because we want to make it very clear to financial markets that monetary policy in the euro area will remain adequate, fitted to economic conditions in the euro area. So we wanted to reassert the autonomy of monetary policy and the ability of the Governing Council of the ECB to ensure that the monetary policy stance in the euro area would remain appropriate for our economic conditions.
You think exchange rate instability in emerging markets should not be a concern at all for, say, the ECB?
I think it's not about exchange rates per se. What is needed, what is absolutely needed, is international dialogue and coordination on the functioning of international capital markets, on the regulation of international capital flows. But for me, it's more about the prudential framework than about exchange rates per se. So it's a discussion on macroprudential measures that can be taken to mitigate the volatility of international capital flows. The discussion has taken place in the G20, in the IMF. It has made enormous progress, by the way, in these two fora, but it's not about exchange rates per se. And I wouldn't advise, and certainly the ECB itself doesn't have an exchange rate target.
Okay, well, thanks. Let me ask you about the euro debt crisis. That was the uninvited guests that spoiled if not the party, that certainly that what appeared to be a recovery that was evolving pretty well. Now, let me ask a specific question. I'll start with you, John. How is the euro debt crisis affected in practice the conduct of monetary policy at your institutions, and how do you view it? How do you see it as evolving over the next, in the immediate future, I guess, the next few years?
Sure.
And I'll ask you to be as brief as possible.
Right, and I'd like to hear the views of my colleagues, too. Obviously, as you said, it was the uninvited guest, and for the U.S. economy in particular, we seem to get nothing but negative shocks during the recovery, and it's made our jobs, the weakness in the global economy, more difficult. The other aspect that affected, so clearly weaker U.S. growth means a need for more monetary accommodation. But I think the more important point was it added a great deal of uncertainty to the global financial system and the global economy. And that's something that we've tried to, I think was one of the drivers for the greater uncertainty, was one of the key drivers for our latest asset purchase program. Not only thinking about how the direct effects on the U.S. economy, but really taking into account these tail or downside risks. So it's definitely been a key part of our thinking about the economy, pushing us in the direction of more monetary stimulus. Clearly, the other concerns around market functioning that we've talked about already is something that we worry a lot about. But from my perspective, the main factor is extending the recovery and the need for additional monetary stimulus on our part.
Benoît?
Well, it's difficult for me to have an outside view on the euro area crisis. Huh? You know, it's like this novel by Stendhal where the hero is in the middle of the Waterloo battle and he doesn't see anything about the battle because he doesn't even understand that it's a Waterloo battle because it's just in the middle of it. So it's a little bit like that. No, what are the lessons for me? I mean, it will be a gradual process to move out of the crisis. Fragmentation, financial fragmentation will stay with us. So we'll have to probably I mean, the way we view, we see, we understand, we assess the euro area economy will probably have changed forever. Conditions in national jurisdictions were not so important before the crisis. They will remain important, even if our efforts to fight financial fragmentations succeed. They will remain. It will remain there. So we'll have to have a particular. I mean, the granularity of monetary policy analysis will be much higher. I would say. One of the other lessons of this crisis is, as I said earlier, that the institutional framework matters enormously, especially when the crisis is compounded by a banking crisis. And the immediate conclusion here is very simple, is that banking union is necessary and it's urgent. It is absolutely urgent that we can set up the single supervisory mechanism for euro area banks and any other country that would like to join, but starting with the euro area, and that we have a single resolution mechanism with a single financial backstop to back it. So the institutional reform has to come along with monetary policy action, and monetary policy action cannot succeed without institutional reform. At country level, countries have to reform and to get together again, to reduce imbalances, etc. This is very well understood now. But also at collective level with stronger institutions to back the single currency. For me, that's the main lesson.
Thank you. Lars, how has the euro debt crisis affected monetary policy in Sweden?
Okay, the euro debt crisis have two consequences for Sweden. First, since the euro area is our most important trading partner, weak development in the euro area means that export demand is weaker than otherwise. So aggregate demand falls in Sweden. The other consequence is that the crisis or the slow recovery in the euro area and also in the UK and in the US means that foreign interest rates will be low for a considerable period ahead. So that everything else equal, that increases the interest rate differential to Swedish interest rates, which means that the krona gets stronger, inflation lower, and also export suffers from a strong krona. So it's obvious with two shocks of that kind, it's obvious that the optimal monetary policy is lowering the policy rate and have very expansionary domestic policy so as to prevent the krona from being too strong and to help export firms survive during the difficult years ahead. Unfortunately, as I just said, the majority has conducted a leaning against the wind policy, mistakenly concerned about household debt. So policy has been much tighter than necessary. And I think it's unlikely. It would be very nice if suddenly we could have much more expansionary policy in this country and not see such a strong krona. But unfortunately, I think it's unlikely that there will be much change. But from a monetary policy point of view, it's pretty trivial what kind of monetary policy you should conduct in a small country like Sweden when you're hit by these two shocks.
Okay, well, thank you. And now as a final question, and before we turn to questions from the audience, let me, and again, I'll ask you to be as brief as possible. Let me ask you, what do you think are the main lessons for the future? I mean, hopefully, sooner or later, we will get out of this crisis. Our economies will be growing at reasonable levels. Inflation will be under control. Now, will monetary policy, and let me ask you to focus specifically on monetary policy. We know, or we hope, that supervision and regulation of the financial system will have changed dramatically. But in terms of monetary policy in a narrow sense, will it be any different from what it was before the crisis, do you think? Or there have been some lessons from the crisis that will affect permanently how monetary policy will be conducted in the future? And let me start with you, Benoît.
Well, we would need a whole seminar to discuss all the aspects. And it's good that we focus on monetary policy, but as we all said, I mean, and as you just said, banking supervision is very important. In particular, our experience in the euro area is that you can't have a proper single monetary policy without a more integrated financial market. So that's a precondition, and then we can move on to discuss the other aspects. But building stronger institutions in the euro area, having the banking union, is a precondition for monetary policy to be successful. So that's not answering your question, but it's an important point. It's an important precondition. Now, when it comes to the monetary policy framework, what we've seen through this crisis is that the ECB didn't have to change its objective and didn't have to change its strategy. I'm not talking about the mandate, because the ECB does not decide on its own mandate. That's a democratic process, and the mandate is in a treaty. So that's totally out of our hands. But we didn't have to change our framework. We have these two pillars. We have the monetary pillar, and we have the other indicators. We've been vindicated in using this pillar. In particular, the monetary pillar, which was very much derided before the crisis and seen as totally obsolete, out of fashion, a legacy from the old world. It has proven absolutely paramount to our monetary policy, because this is about credit provision. This is about the liabilities of banks, and it has been very important in this financial crisis, in this banking crisis, to follow credit and the situation of banks. And this is embedded in our monetary pillar. So we've been vindicated in using it. We didn't have to change our target, which is inflation below 2%, close to 2%. And I would say that it's precisely the fact that we haven't changed our framework, we haven't changed our objective, which has given us a lot of short-term flexibility. I don't see a trade-off between long-term flexibility and short-term flexibility. The more credible your long-term target, the more you can be flexible in the short term. And our main asset through this crisis has been the fact that inflation expectations in the euro area has remained very well anchored, close to 2%, even though the economy and the financial system was in a turmoil. And this is it's long-term credibility that has made it possible for us to invent new instruments, to use flexibility in the short term, to depart from the 2% objective in the short term, because we could rely on these long-term assets. So some of the instruments that we've introduced may stay with us. Forward guidance may stay with us. Some changes in the collateral framework may stay with us. We'll have operational issues, certainly, with an enormous amount of excess liquidity in our system. We are currently in a situation where the money market rate is close to the deposit facility rate, because it is compressed by excess liquidity. So the most important policy rate, in a sense, is the deposit facility rate currently. It's not the rate for the marginal refinancing operations, because the EONIA is very close to the deposit facility rate. As liquidity goes down because of the normalization, the EONIA and the money market rate will begin to have more ample fluctuations, and we'll have to rethink the way we monitor the money market rate in the euro area. So we will need a reflection on our operational target. So that's an example of the issues we'll have. But the mandate, the objective, and the monetary policy strategy will stay.
Thank you. Lars, very briefly, please.
Okay, I think at least for Sweden, an important lesson is that one should keep monetary policy and financial policy or macroprudential policy separate. One shouldn't mix them up. They are separate policies. They have separate objectives. separate suitable instruments, and in many cases separate responsible authorities. Monetary policy cannot achieve financial stability.
Someone disagrees, Lars.
I think monetary policy should focus on the monetary policy objective, stabilizing inflation around the target and unemployment around a long-run sustainable rate. As of yesterday, actually, in Sweden, we have now a new micro and macroprudential framework announced by the government. And I think it's actually quite good. The plan is to keep micro and macroprudential policy together with one authority, good for efficiency, policy conflicts and accountability. And the authority is Finansinspektionen, the FSA. And it has lots of tools, and it will get more tools to maintain financial stability. The Riksbank in that situation should and hopefully will focus on the monetary policy objectives, stabilizing inflation and the real economy, and not neglect the price stability objective or the government's objective of full employment in some attempt to affect household debt or financial stability when monetary policy cannot really achieve that. So I think it looks good. The institutional setup in Sweden looks good for the future, and accountability and efficiency, I think, will be taken care of.
Thank you, John.
Sure. I'll focus just on the unconventional monetary policy in terms of the future of that. I think, as I said, both our asset purchase programs and our use of forward guidance have been incredibly important tools in the last few years, especially with us at the zero bound. Looking forward to when policy is more normal, I think one of the I would expect that we would go back to using short-term interest rate as a primary policy instrument. I think there's a lot of uncertainty and some costs associated with using the asset purchases as your main policy instrument. So I think my view is when we get to normal, we'll go back to using the short-term rate as our policy instrument and try to get our balance sheet back to a normal size and composition. I do think a fundamental change of the Federal Reserve has been a shift, not in so much our objectives, but in our communication of our objectives. One of the great things we accomplished in the last few years was to be clear what our inflation objective was, long-term inflation goal of 2%. At the same time as explaining, I think, pretty clearly that we have a dual mandate about employment and price stability, and that we take a balanced approach to achieve both of these objectives in practice. So I think, in addition, we've used forward guidance both through giving out our interest rate projections from the committee, something that the Riksbank started much earlier than we did, but I think a great improvement in transparency and forward guidance. And clearly in the last few years, the Federal Reserve has been on the forefront of using pretty explicit forward guidance, especially now that we're at the zero bound, about when we'll raise interest rates and what the future policy will be there. So I think that's been a sea change in monetary policy for the Fed. I see forward guidance in whichever form in the future, in a different form probably than today, but forward guidance being a key part of how we communicate our monetary policy strategy to basically help people understand our reaction function and also understand when we deviate from that, perhaps normal reaction function, and help people understand that. So to me, that's a big change. I think that will probably be more likely a permanent part of our monetary policy approach, and I think it's a very positive development.
Okay, thank you. I think Benoît wanted to add something very quickly.
Just listening to what John was saying on communication, I mean, my personal conviction is that the crisis reinforces the need for central banks to be transparent and to be accountable. Crises are difficult times for all the people. Crises generate enormous redistributive movements, enormous transfers in the society, which the central bank has to be protected from. You have to protect the central bank from being an instrument of redistributive policies. This has to be done by elected governments. And at the same time, anything that the central bank does has redistributive consequences, which are proportional to its objective of price stability, but they are there, and where you have to explain what you're doing, why you're doing it, and you have to be accountable to the people. And this is why, as far as the ECB is concerned, that, for instance, I would say that one of the consequences of the crisis is that it makes the publication of the minutes of the monetary policy discussions necessary and useful.
Okay, well, thank you. Okay, so now you have a chance to ask some of the questions that I didn't dare to ask. Anyone wants to ask a question? Xavier. Please. Oh, you have a microphone. Okay.
Yeah, the question, in fact, I think Lars has said something at the end about what I want to ask, but I would like to know the opinion of the ECB and the Fed on this. Do you see any potential conflict of interest between the supervisory function of a central bank and monetary policy? In the US, you have more practice, but now in Europe at the ECB, it will take this new task.
Who do you address it to? One of you wants to.
Okay, I thought you were. I actually see these as complementary. Obviously, understanding what's going on in the financial system, the banking system, having a robust, resilient financial system is incredibly important for successful monetary policy. I do see them as complements. I'm not as convinced as Lars that financial stability and monetary policy are completely separate spheres. I actually think they interact in very important ways. So I think that this is a very complementary approach to have supervision within the central bank.
Well, no, in our case, I see both risks and opportunities. Strong banking supervision can support monetary policy, as we've said earlier in the discussion. I very much hope it will support strong monetary policy by ensuring that the euro area banking system is safe and that the balance sheet of the banks are safe. So it can be supportive, but there are also risks of conflicts of interest. We know very well that there is a risk of financial dominance over monetary policy. And this risk of financial dominance is even more pronounced in a financial crisis, where banks need money. They need to be recapitalized. And governments, taxpayers are never happy to give money to banks. So now we are moving to another concept, which is bail-in, which is better in my view. But it will not be about taxpayers, it will be about investors. Investors will not be happy either to give money to banks. So there will always be enormous pressure on the central bank to do the job of governments or to substitute for investors when it comes to recapitalize banks. And we have to protect monetary policy from these kind of pressures. So as far as the ECB is concerned, we'll have separation within the ECB between the monetary policy part and the banking supervisory part. There will be contacts, discussions, exchanges of information, but the decision-making processes will be separate.
Klaus?
So, Klaus Adam from University of Mannheim. So I have a question to Benoît Cœuré. So one of the programs that you haven't mentioned is the security markets program, which supposedly has been superseded now by the OMT program. And the OMT program has been an enormous success, I think, in terms of bringing interest rates down. And maybe even the ECB was surprised by the amount of, of the size of this sort of effect. Now, you said the OMT comes with a stick and it comes with a carrot. So you need to sort of submit to the Troika program in order to be able to get an S&P-like purchase program. So what do you think in terms of the risks of other players not playing according to your rule book, and especially large countries such as maybe Italy or Spain simply not submitting to Troika ruling and instead relying on other measures, and the ECB having shown its willingness to sort of mop up the downside risks, having to come up with some sort of other program instead?
Well, if you don't want to go to the doctor, you don't go to the doctor. That's a choice. So if we see the program not being requested, either because countries themselves don't want to request it because it comes with a stigma and they don't want the conditionality that comes with it, or also because the other euro area countries wouldn't like to provide this kind of assistance to any particular country, then we'll take it as a fact. OMTs are not about subsidizing government yields. They're not about bringing government yields towards the levels that would ensure fiscal solvency. OMTs serve a very narrow purpose, which is to avoid redenomination risk, meaning to avoid a kind of self-fulfilling equilibrium where a country would leave the euro area because of this very high level of yields. So it's about euro area breakup. If euro area governments don't want to save the euro area, then it's not the job of the ECB to do it.
Richard Portes.
Thanks. Richard Portis, London Business School and CEPR. First, a quick comment, and it's for the doctor. The statement that floating exchange rates ensure the autonomy of monetary policy is what we used to think, the trilemma and all that. Recent research suggests that that may not be correct, and we can talk about that later. But questions, very quick. One for the doctor, and that is the asset. You clearly think that banking union is urgent, that we delayed too long in dealing with the bank's problems, and yet the asset quality review isn't going to be until sometime early next year. Stress tests, serious stress tests have been long delayed. What's the reason for these delays? Why is it that we haven't been able to grapple with that problem? A question for John, and that is why do you think that the large balance sheet in itself is a problem? Why is it a problem? Who cares, provided that you're dealing with other things properly? And a question for Lars. I have a question here somewhere. It seems that monetary policy in Sweden was, as you put it, departing from the inflation target objective to deal with what are effectively macroprudential issues. Household debt is the one you fix on. Why didn't Sweden use directly macroprudential measures? Loan-to-value ratios, we worry about the housing market, worry about household debt. Why not proper macro-pru?
Very quickly, please, because we have to conclude this session.
Well, first I would be grateful to Richard to send me the recent research that shows that the Mundell triangle is not there anymore. I used to tell my students that it's the only thing that you have to know in international macro, and the rest doesn't matter so much, but so I was probably wrong. Well, sorry. Second, delays in setting up the banking union. Well, first, it's not so long. Yeah? When you consider what single supervision and maybe at some point single resolution represent in terms of institutional change for Europe, it is absolutely path-breaking, and it happened in a time span of 1 year. When you compare it to other European processes, it is very fast. So why are there delays? There are two reasons. First, the first and foremost reason is democracy. Europe is a democracy. We live in democracies, and so this is a regulation by the European Council and the European Parliament. It has to be discussed within the European Council and then within the European Parliament, and then between the two of them and with the Commission, etc., etc. It takes time. I think it's good that any step in our reform process is validated by democratic processes, even more so when it comes with sovereignty transfer. And this is an enormous sovereignty transfer by European countries. It's good that we have this democratic process. It takes a little bit of time, but I think it's a price worth paying. Second answer, we are setting up a new institution, which is this new banking supervisory agency within the ECB. It takes time to have the right concept. It takes time to harmonize the supervisory concepts of 17 countries. For the first time in history, you will have the same measure of liquidity and the same measure of capital across euro area countries. That's already an enormous achievement. It takes a little bit of time. I'm sorry for that.
John?
So, quick answer, since we have very little time, I don't think there are costs to just the size of the balance sheet on its own. I do think that since the size of the balance sheet is, in a way, a measure of how the magnitude of our unconventional policy actions, and given the great deal of uncertainty about these effects on financial conditions in the economy, I do think that there are standard Brainerd uncertainty kind of considerations in thinking about using this tool given the great deal of uncertainty with it. But in answer directly to your question, I don't think there are especially large costs associated with a large balance sheet.
Okay, in response to Richard, the fact is that the FSA and the government has undertaken effective measures, used the macroprudential tools, and they have asked for higher capital requirements for systemically important banks. They have introduced an LTV cap for new mortgages. There are higher risk weights for mortgages underway. There is a thorough mortgage market report that scrutinizes banks' lending standards. The Riksbank has actually repeatedly said that there is inaction bias among other authorities, but that is not true. They have actually been quite active and have done precisely the right thing.
Okay, well, unfortunately our time is up, so let me just thank our distinguished panelists for sharing their views, and thank you all for your attention.